Welcome everyone to part 2 of our series on navigating public improvement projects during COVID-19. I'm Bart Fisher, the Senior Public Administrator at WSB, and with me today is my co-moderator, Chris Petrie, who is Director of Rochester Operations for us at WSB. All of us have been affected in unprecedented and profound ways by the COVID-19 virus. We at WSB want to be a resource to you during these challenging times. That is why we have put together this two-part series on navigating public improvement projects during the COVID-19 virus. The topics that we will discuss today are current financial conditions and project financing options. On behalf of the entire WSB team, we appreciate you taking the time to take part in this webinar series. As mentioned, we are happy to be a resource for all of you. However, we also would like to remind everyone that the information and resources provided are predicated on the approval and acceptance of your organization's attorneys. Also with us today are our partners, Paul Steinman, who is a director with Baker Tilly, and Nick Anhut, who is a senior municipal advisor with Ellers. Welcome, gentlemen, and at this time, I'm going to turn it over to my co-moderator, Chris Petrie, to begin our conversation with Paul and Nick.
Well, thank you, Bart, and thanks, Paul and Nick, for joining us. So what we're going to start talking about today is really current financial conditions. Bart's going to go on to the next slide here that introduces our presenters, and we're going to talk about project financing options that our municipal clients are considering. So I'm going to turn it over right now to Paul Steinman, Director with Baker Tilly Municipal Advisors. And the first really part, Paul, that I want to ask you about is what a lot of folks, I know your clients, a lot of our clients are struggling with or talking about right now, and that's about issuing debt. And one of the big questions I know you've heard probably even far more than us at WSB is, can borrowers access the bond market at this time? What does that look like?
Well, first of all, thank you, Chris and Bart and WSB for the opportunity to participate in your webinar. Appreciate that. So the question, can borrowers access the market, the muni market at this time? There was a time that I would have said borrowers could issue debt, access the market at any time, and that access was simply a matter of their interest rate tolerance. But this year was a little different. Somewhere around the third and the beginning of the fourth weeks of March, it simply wasn't the case. The market was what we would refer to in the industry as illiquid, not liquid, not able to provide investors for our for municipal bonds. So actually, we were taking some unprecedented steps at that time and recommending to some of our clients that they hold off on execution of contracts for spring projects until we could witness at least some degree of market stabilization. So Baker Tilly and I know other MAs as well across the board, we had multiple competitive sales that were canceled or postponed for various projects. And the few that were bid competitively during that time, for the most part, they weren't receiving any investor interest, so you weren't getting any bids. For the first time in a really long time, probably in my memory, investors were moving away and out of stocks and away and out of bonds at the same time. And generally, those two actions have an inverse relationship. When folks are moving into stocks, they're moving out of bonds and vice versa. So I guess all of that does appear as though it has worked its way through the system for the time being. The answer then today to the question is yes. We think that borrowers can access the market today. Investment grade borrowers and certainly A-rated and above borrowers shouldn't have any access problems to the market today. It began to stabilize somewhere around the first and second weeks of April, and we're cautiously optimistic that will continue. Cautiously optimistic. We've had a number of successful competitive sales, and I know across the board others have as well. Our sales have ranged from the low millions of dollars to upwards of 90+ millions of dollars in bonds, and we've had positive market acceptance, narrow bid bands, and good satisfactory transactions in the last several weeks.
Great. So speaking to that, Paul, and I know you talked about since COVID-19, how things have transpired in the last 6 or 8 weeks, and you talked specifically about what you're seeing in the early part of April now as we transition into May. But really, how does the market compare today to 6 months or maybe a year ago and especially maybe what you saw in early April as far as rates, liquidity, accessibility?
Thanks for the question, Chris. Bart, if you give me authority, I'll share a slide and discuss that topic a bit. Thank you. So rates are still, I know it's hard to believe we've been saying this for so many years, it seems like. Rates are still historically very, very low. This first graph just gives us an indication of what has happened in the last 4 weeks, 5 weeks in the market. This teal colored line shows the yield curve as of yesterday, April 30th, 2020, this teal line, and you can see that it's a bit higher than on April 23rd of 2020. If you look at the legend on the bottom here, April 23rd of 2020, rates and the yield curve were slightly lower than they are today. And on March 30th, 2020, they were even lower. So the market has come up since March 30 as it has stabilized. But the very top line here represents the yield curve as of April 30th, 2019. So still, compared to a year ago, we have low rates. And this chart will just give kind of more of an overview historically. The black squares represent the historical average yields on the MMD scale, the Municipal Market Data scale. It's an index showing the yield curve. So historically, the black squares represent the average, and these teal or green squares below are where we were as of April 30th of 2020. So again, it just shows in the early years here we were still 100 basis points or 1 full percent below the historical average, and in these out years between 5 and 20, in the neighborhood of 200 basis points or 2 full percentage points below the historical average. So we're still in a very good interest rate environment.
Well, terrific. Well, after hearing all of that, what do you suggest? Do you think now is a better time, even that we're well below average with some of those graphics that you've shown the historical average? Do you feel like now is a better time for your clients, our clients, to consider conserving cash?
So that's another great question, Chris. It's almost as though these questions were predefined to some degree. Thank you. That is a good question. We've had it many times from clients and various entities over the last month. So it's really, this question is really going to depend upon where you're at with your entity and what unique characteristics are of your entity. Typically, when money is cheap, investment rates are very low. So for some, it's logical to borrow money for capital projects when money is cheap. To others, it's just as logical to spend cash when there is no opportunity to invest that cash and make a decent return. So just a couple primary issues to consider here. Do you have ample cash reserves? That is an important question when we address the credit rating question coming up later on our agenda here. And then lastly, if I spend cash on capital projects, what happens if I later need my cash for something that I may not be able to borrow for? So two primary issues to consider in that.
I'll say, okay, so keeping on the same theme with kind of the cash flow piece, are there temporary borrowing options for issuing short-term debt for project cash flow? Something else to consider with what we're talking about here.
Yeah, so there are options for borrowing short-term to assist with cash flow. Let me put my disclaimer in here that I'm not a bond attorney, but sometimes bond attorneys get to play municipal advisors, so I feel like I have a little bit of flexibility here. So there are options for emergency debt certificates and tax anticipation notes. Both cities and counties are eligible, and I won't recite the statutory references, but if you have questions about those, you can reach out to your MA and your bond counsel with those questions. There are options available.
Excellent. Well, thank you, Paul. I think we're going to take a pause there, and I'm going to turn it over to my co-moderator, Bart Fisher, and he's going to take it away on kind of the second part of this conversation. Bart?
Well, thank you, Chris, and thank you, Paul. Yes, I did want to dive in here and bring Nick into the conversation. Nick, we've been hearing from some of our partners and clients the question regarding whether or not to restructure financing, their current financing, to better serve operations and debt service during this time. So could you talk specifically about how organizations might measure the impact of the pandemic on repayment sources, such as delayed or reduced tax payments, utility revenues, and sales taxes?
Well, first and foremost, thank you, Bart and Chris, as well, for the opportunity, and WSB as a whole. In response to this question, obviously our communities are feeling the crunch during this time, not only internally with our own finances, but then also our constituents as well are feeling the crunch, and there are various programs being offered or discussed to provide for some temporary relief in terms of tax payments, in terms of waiving fees or penalties for late payments. Certainly not just property taxes, but also many utilities are considering those aspects as well, just to provide some relief to our constituents during this time of hardship. So as we do look at the potential impact of new debt, we're bringing on a new financial obligation, a new liability onto the books, and we're going to rely on those very same revenue streams that we're potentially looking to alleviate in order to pay back this debt. We're going to have to include those within our budgets. Certainly, it's unknown right now the extent of the pandemic, how long or a prolonged impact this is going to have, but it's fairly safe to assume that it's definitely going to impact this budget year, our current collections, as well as potentially into next year as well. And so as we look at the potential repayment sources for our bonds, most projects are going to be looking at the impact of a tax levy on the constituents, establishing assessment streams for improvement projects, street and utility work that's going to be assessed to the benefiting property owners. Those assessments are likely to hit the books within the next year and become a payable for those benefactors of the project, relying on established utility revenue streams. And then for many of our communities, at least in Minnesota, a new source of funding has become sales tax, as many communities have gone and gotten new sales tax authorizations from the legislature and are implementing those sales taxes as we speak. Certainly each one of those revenue streams is going to be impacted differently, but we can be safe to say that there is going to be some level of impact in the short term against all of them. Most acutely, probably within the sales tax, depending on the community. And if you have a general obligation bond that's backing your project, the expectation is that if that dedicated revenue stream doesn't come in as projected, like a sales tax, the community is going to have to find some other source of funding to make up the difference. So this question is very pertinent at this time. We definitely advise our clients to have some thorough discussions, not only with their boards, their governing bodies, but internally between departments, finance, as well as public works, to really decide what is the proper repayment source and what kind of impacts do we think are going to happen here in the short term, and then flesh out some discussions about options. What can we do? So to bring that back to your question, namely, there is a lot of flexibility within the dedicated repayment of a general obligation bond. That's a bond that is backed by the full faith and credit of the community. Again, saying that even if the intended revenue source, call it a utility revenue or a sales tax, is not going to be able to pay the entire amount, the city is going to find some other resource, namely a property tax levy, to make up the difference. So with a general obligation bond, under the statutes, you have the opportunity to structure payments out for as many as 30 years. Many of our clients have established structures for how they like to repay their debt and long-term financial plans to make sure that they're keeping on track and amortizing their projects appropriately so they can maintain capacity for future financial obligations. Now might be a time to consider deviating from said policy and thinking about whether or not it would be beneficial to our taxpayers, to our primary revenue sources, if we lengthened the term of repayment by just a little bit to kind of bring down that annual impact. Also, under the statute, you do have the opportunity as well to defer principal payment for up to 3 years with these types of bonds. We like to pay back that principal right away so that we can limit the amount of accrued interest and again, pay off those liabilities so we have that capacity in the future. But now might be a time where we think about delaying some of those initial payments again to allow our revenue streams to stabilize with this new normal after the pandemic and be able to focus our current assets on our operations and not necessarily having to feel the impact of the new debt right away. Now, all of this comes with a cost, and your advisors can certainly walk you through the pros and cons and the potential impacts of all of those.
Well, thank you, Nick. One other, sorry, I'm going to take a pause. One other question that I think a lot of our clients are looking at, or one other funding source for projects is, and bonds related to projects is assessments. So could you discuss a little bit more about whether or not an organization should consider temporarily changing their assessment policy, such as deferring the assessments?
Thanks, Bart. Yep, and I think this segues right into the discussion that we just had. Certainly some flexibility in the timing and the potential burden to our, ratepayers or taxpayers. A community does have some flexibility. Many communities are right now grappling with this topic. We do have policies implemented locally about assessments to make sure that they're consistent among our many projects so that there is an equal burden or impact across the board for the community, and those are important. But now might be a time to consider whether or not to implement a change in that policy, whether it's temporary or again, to carry it forward, to think about maybe lengthening the time that those assessments will be collected, or potentially even deferring some of those collections. There is some flexibility at the governing body level to do that within the 429 assessment hearing process. Again, those are discussions that need to take place up front. Once the financing is actually executed, you're going to have to repay that debt. And if that revenue stream is not available or it's being deferred, you're going to have to come up with another source of revenue to make up the difference. But there certainly are some opportunities right now to have those discussions at the community level and to think about ways to alleviate the potential burden.
You know, you already kind of addressed this, Nick, in some of your comments, but wanted to give you an opportunity as well. I know you talked about even deferral of the principal payments for bonds. What about delayed interest and or delayed payments for debt service? I know you've kind of already addressed that, but is there anything else you wanted to add on to that?
You know, I think I'll bring it back and just sort of revisit the topic. But yes, generally speaking, as I mentioned, you do have the opportunity to delay some of your initial payments. You can include capitalized interest within the sources and uses of funds, so you can actually borrow the amount necessary to cover your construction period interest expense. This could be for up to a period of potentially 3 years, or whenever that first principal needs to be made. It carries a cost. You're borrowing money to provide for that, but it does allow you some flexibility to delay or defer those revenue streams, allow them to impact the community at a later date. So in addition to that, I think to segue into one of the topics that Paul discussed as well, we talked about temporary borrowing options for cash flow purposes. You could also structure your financing for construction purposes to temporarily borrow an amount that you plan on refinancing within the next 2 to 3 years once those revenue streams are stabilized, and therefore cover the construction period and then execute some form of permanent financing, 1 to 2, 3 years from now when conditions are more appropriate. This could be also a way that you bundle projects together. If the community is considering maybe its initial plans were biting off a little bit more than it can chew right now, and is paring down some of its capital plans for the year, and you had intended to move forward with a bond, this might be a way to still provide the financing for a smaller project and then wrap it in with your larger projects, potentially next year or in the future when you actually are ready to move forward with them. So these are all things that communities can consider, and there are flexibilities within the statutes and policies to do that.
Well, thank you, Nick, for your insights on those topics. Chris, I'm going to turn it back over to you for some wrap-up questions with Nick and Paul.
Great, thanks, Bart, and thank you, Nick. So one of the questions I wanted to ask both of you, as clients, our clients, your clients, everyone else is tuning in and listening to this, something, as both Bart and I are former public sector employees, and it's something that's frequently discussed, and something, Paul, I know you mentioned in your points, but should municipalities be worried about their credit rating, and what can they do in this market and right now to protect that rating? Paul, maybe you want to go first.
Yep, thanks, Chris. I appreciate that. So with regard to the credit rating, the number one item on the credit rating is that cash is king. Liquidity is the name of the game right now at this moment. So focus on your cash and your cash reserves. If you have more than about 40% of your next year's budgeted expenditures in reserves, which I think most cities and certainly almost all counties in this state do, that is great. The least impacted issuers are going to be those with high fund balance and limited exposures to areas like sales tax, transit tax, hotel taxes. So those are going to be the least impacted issuers. Secondly, as far as I have seen, S&P has only downgraded about 10 issuers in public finance. So rating agencies really haven't been taking many downgrades, and especially in the local government space. The only downgrades I have seen that have happened have already been with weak credits. And lastly, and then Nick can add if he likes, the ratings in general, they take into account normal economic cycles, and we're in anything but a normal economic cycle. So most Minnesota governments will be unimpacted in the near term. That's what we think. But as these implications of the downturn become clearer, it's going to be really a developing story. And we think most of the risk to ratings is really out probably 12, maybe even 18 months from this point.
And if I can just add, each one of the rating agencies has their own particulars or purview, but generally speaking, they are looking at what is a global pandemic or recessionary impact. So they all do have a bit of a negative tinge in their perspective, but within the municipal space in particular, as Paul mentioned, we just have not seen the actual attempt to downgrade, and particularly here in Minnesota with the majority of our cities that are the audience for this webinar. Quite frankly, there are a level of questioning that's taking place during the rating process. So your finance departments are going to need to be able to address, whether or not they can estimate the short-term impacts to their revenue streams, be it property taxes, utility revenues, sales tax, and the like. But we haven't seen that actually play out to impacting someone to bring forward an actual downgrade. So even though there is this negative outlook among the rating community on the global economy at large, the municipal space, at least here locally in particular, has been sheltered from that somewhat, but there is definitely a heightened level of scrutiny in those discussions.
Great. Well, thank you both for those responses. So I do want to wrap up and close, and Bart will give a few closing comments in a minute, but I know a lot of folks out there there's been discussions about potential stimulus packages, and while we're not going to dive into that because it's a little premature, I think with everything going on, maybe just in your closing comments, and I'll start with you, Nick, since we gave Paul the floor on the question before, but thoughts specifically maybe at a state level, things that you're hearing related to stimulus opportunities for local units of government?
Sure. So the legislature is in session as we speak, but obviously the governor has taken a couple of attempts to address not only our municipalities directly through the league and other sources. Right now we're not anticipating that there's going to be a significant change to property tax collections. A number of counties are, as we mentioned, taking some steps to alleviate the penalties associated with late payment, but generally speaking, the payment dates and your settlements are still, for the most part, on track, and they're not being adjusted by the legislature. We've also heard that the governor has addressed trying to ensure that there'll be minimal impact, if no impact whatsoever, to any local government aid, municipal state aid payments. Those revenue streams should still be available at least during this budget year and through this cycle. But again, we'll see much more unfolding. I'm sure there will be some programs potentially on the capital side to help facilitate some utility and street improvement projects, but more to come on that aspect.
Okay, thanks, Nick. Paul, some thoughts on stimulus?
Just a couple additional thoughts. Thanks, Nick. Nick sort of covered the public side of the stimulus equation. Maybe I'll just deal with the private side quickly here, and that was the CARES Act, and I don't know how many millions of pages that bill was, but a lot. My best advice would be go to the Baker Tilly website and you'll see a complete overview of the CARES Act. A lot of it, in fact, almost all of it relates directly to private business stimulus, the Paycheck Protection Program, et cetera, et cetera. But of course, providing local business stimulus is super important for all of our entities, protecting Main Street. There was one issue called a municipal liquidity facility that was included there, that a way for the federal government to allocate and loan money to states and large cities. And then in turn, those states and large cities have the ability to loan those same dollars out to local entities. We think that is sort of a lending facility of last resort, or at least that's sort of the way it appears it's going to shape up to be. But again, there's a lot of information out there on it. It's called the Municipal Liquidity Facility. And I don't know that in Minnesota, I just have a good feeling that this is gonna be more of a V-shaped recovery than a deep U-shaped recovery like we had in 08, 9, 10 through 12. That we'll be able to see less impact and a sharper recovery curve. So that's my hope.
Great. Well, thank you both for that. I'm going to take a moment now to turn it over to Bart Fisher, my co-moderator, for some closing comments.
Well, thank you, Chris, and we want to thank all of you for participating in this webinar. We really value you value you and your continued commitment and support and partnership with WSB. I also want to thank our presenters today, Nick with Ehlers and Paul with Baker Tilly. Thank you for your insights and thank you for your partnership on this webinar. I'm going to be putting up a slide here with all of our contact information. And should you have any additional questions for us, please do not hesitate to reach out. We really appreciate that. And again, we appreciate your time. Finally, just want you all to stay safe and healthy, and hope to see you again very soon. Thank you, and have a great day.